your bank is not your friend. I know that sounds harsh. I know you have probably had an account at the same bank for 20 or 30 years. You know the tellers by name. You trust them, and I am not saying they are dishonest people. What I am saying is that the institution they work for is structured to extract money from its customers in ways that are completely legal, often invisible, and disproportionately harmful to people who are retired and living on fixed incomes. The fees, the low interest rates, the product recommendations, the account structures that banks use every single day are not designed with your retirement in mind. They are designed to maximize revenue for the bank, and because most retirees are loyal customers who rarely shop around and rarely question what they are being charged, they make ideal targets. My name is Margaret, and today we are going through 6 ways your bank may be quietly taking money from you after retirement, and exactly what you can do about every single one of them. This is not about conspiracy theories. Every single thing I am about to tell you is standard banking practice that you can verify and just start today. If this is your first time here, hit subscribe right now. Let's get into it. I want to start with a man named Bernard. Wait, you know Bernard from a previous video. Let me introduce you to someone new. His name is Howard. No, you know Howard too. Let me introduce you to a man named George. George is 69 years old and lives in Phoenix, Arizona. He retired 3 years ago after a long career as a school principal. George is not naive. He ran a school for 20 years. He managed budgets. He dealt with contracts. He is an educated and thoughtful man. But like most retirees, George assumed that his bank, the same bank he has used for 27 years, was giving him reasonable rates and treating him fairly as a long-term customer. He was wrong. When George finally sat down and reviewed everything his bank was charging him and compared it to what was available elsewhere, he found 6 specific ways his bank was taking money from him that he had never thought to question. Together they were costing him over $2,000 a year. Money that was quietly leaving his retirement account every 12 months, without a single conversation, without a single warning, and without any action required from the bank, beyond continuing to do what they had always done. The first way your bank is taking money from you after retirement is through savings account interest rates that are dramatically lower than what is available elsewhere. Right now, in the current interest rate environment, many major national banks are paying between 0.01 and 0.5% interest on standard savings accounts. Some are paying even less. Meanwhile, high-yield savings accounts at online banks and credit unions are paying between 4 and 5% annually on the same type of deposits. The difference sounds abstract until you do the math. If you have $50,000 in a savings account, earning 0.05%, you earn about $25 per year in interest. The same $50,000 in a high-yield savings account, earning 4.5%, earns over $2,000 per year. That is a difference of nearly $2,000 annually, not from any investment risk, not from putting your money in the market, just from moving it to a different type of savings account. George had $80,000 sitting in his bank's standard savings account, earning almost nothing for 3 years. He had no idea that simply moving that money to a high-yield savings account at an FDIC-insured online bank would have generated thousands of dollars in additional interest during that time. The money was safe, either way. The only difference was where he kept it. The second way your bank is taking money from you after retirement is through monthly maintenance fees and minimum balance fees that quietly drain your account. Many banks charge monthly maintenance fees on checking and savings accounts that range from anywhere between $5 and $25 per month. Some waive these fees if you maintain a minimum balance. but the minimum balance requirements can be substantial. And if your balance dips below the threshold even once in a month, the fee applies. For retirees who are drawing down their savings on a regular basis, maintaining the exact minimum balance required to avoid fees can be genuinely difficult. And many people who have been with a bank for decades simply assume they are not paying these fees because they remember when the fees were waived years ago. Check your statements carefully. Look for any monthly fee, any maintenance fee, any service charge, any minimum balance fee. Add up what you have paid over the past 12 months. Many retirees are shocked to discover they have been paying $100 to $300 per year in fees they either did not know about or forgot they were paying. George was paying a $12 monthly maintenance fee on a savings account he had opened years ago when the bank's fee structure was different. That is $144 per year for the privilege of keeping his own money in their bank. The third way your bank is taking money from you after retirement is through CD rates that are significantly below the best available options. Certificates of deposit, or CDs, are a popular choice for retirees because they offer a fixed guaranteed return with FDIC insurance. Banks know this, and banks also know that many retirees are loyal and do not shop around, which is why the CD rates offered by major national banks are consistently and significantly lower than the rates available at online banks, credit unions, and through Treasury securities. Right now, the difference between the CD rate at a major national bank and the best available rate on a comparable CD can easily be 1 to 2 percentage points. On a $100,000 CD, that is a difference of $1,000 to $2,000 per year in interest earned. Treasury bills and Treasury notes, which are backed by the United States government and carry no default risk, often offer rates that are competitive with or superior to bank CDs and have the additional advantage of being exempt from state and local income taxes. George had a $100,000 CD at his bank, earning 2.1%, when comparable online banks were offering 4.2% on the same term. He was leaving over $2,000 per year in interest on the table simply because he renewed his CD at his existing bank without shopping around. The fourth way your bank is taking money from you after retirement is through overdraft fees and insufficient funds fees that disproportionately affect people on fixed incomes. This one is particularly painful because it tends to hit people at the worst possible moments. Retirement income often comes in on a fixed schedule. Social Security arrives on a predictable day each month. Pension payments come on a set date, but expenses are less predictable. A medical bill arrives unexpectedly. A home repair comes up. A prescription costs more than anticipated. And if any of these expenses hit your account before your next income deposit, the result can be an overdraft. Banks charge between $25 and $35 for each overdraft transaction, and many banks process multiple transactions simultaneously in a sequence that maximizes the number of overdraft fees charged. If you have a small negative balance and 3 or 4 pending transactions, you could face 3 or 4 separate overdraft fees in a single day. Some banks have faced legal action over these practices, and some have reformed them, but many continue. The protection against this is simple. Most banks offer overdraft protection that links your checking account to a savings account or a line of credit and covers overdrafts automatically at a much lower cost. Ask your bank specifically whether you have overdraft protection set up and at what cost. If you do not, set it up today. The fifth way your bank is taking money from you after retirement is through bank recommended investment and annuity products that pay high commissions to the bank and modest returns to you. Many banks now have financial advisors, wealth management centers, or investment product desks right inside their branches. When you walk in to deposit a check or renew a CD, a friendly banker may suggest a meeting with their financial advisor to talk about how to make your money work harder. This feels helpful and convenient. The problem is that the products these advisors recommend are often high commission products, like annuities and proprietary mutual funds, that generate significant revenue for the bank. The advisors in these bank wealth management centers are often not fiduciaries, meaning they are not legally required to recommend what is best for you. They are required only to recommend what is suitable for you. And as we discussed in a previous video, suitable is a much lower standard than best interest. George sat down with his bank's wealth management advisor and was shown an annuity product that looked appealing on the surface. What the advisor did not mention was the commission the bank earned from that product or the surrender charges George would face if he needed to access his money early. George did not buy it that day, but he came close. The sixth way your bank is taking money from you after retirement is through wire transfer fees, foreign transaction fees, paper statement fees, and other small charges that add up over time. Banks charge fees for many services that customers assume are free, or that customers have forgotten they are being charged for. Wire transfer fees can range from $15 to $35 per transfer. Paper statement fees of $1 to $3 per month can add up to $12 to $36 per year. Foreign transaction fees on debit card purchases made internationally or from foreign vendors can add 1 to 3% to every transaction. Cashier's check fees, account closing fees, returned mail fees. Each of these is small individually. Together they can add $50 to $200 or more per year to what you are paying your bank. George had been receiving paper statements on 2 accounts, paying a wire transfer fee twice a year when he helped his daughter with expenses, and paying a monthly fee for a checking account feature he had not used in years. Together, these added about $180 to his annual banking costs. Now here is what George did when he finally understood all 6 of these issues. He opened a high-yield savings account at an FDIC-insured online bank and moved his savings there. He earned over $3,000 more in interest in the following year than he had earned the year before. He switched to a free checking account and eliminated his monthly maintenance fee. He shopped CD rates before renewing and found a rate that was nearly double what his bank offered. He set up overdraft protection. He declined the annuity product and instead worked with a fee-only fiduciary advisor for a one-time review, and he switched to paperless statements and reviewed all the small fees he had been paying. Total savings in his first year of changes, just over $2,400. That is money that stayed in George's retirement account instead of flowing to his bank. Not because George did anything complicated, because George finally had the information he needed. Here is what I want you to do today. Pull out 3 months of bank statements from every account you have. Look for every maintenance fees, minimum balance fees, paper statement fees, overdraft fees, wire fees. Add them up, write the number down. Then go to a website like Bankrate or NerdWallet and look up current high-yield savings account rates and CD rates. Compare what your bank is paying you to what is available elsewhere. The difference may surprise you. And if you have ever sat down with a bank financial advisor or been shown an investment product by your bank, revisit that product with fresh eyes. Ask whether the advisor is a fiduciary. Ask what commission the bank earned. You have the right to know. Your money worked hard to get where it is. Make sure it is working just as hard for you in retirement. Subscribe to this channel if you have not already, and share this video with someone you care about. I am Margaret. I will see you next week.